Who doesn't want to be a billionaire? For the fortunate few who have really achieved this financial pinnacle, they can be completely financially free. But for you and I, it might be a different story. When it comes to those billionaires and managing wealth, it might not be in our best interest to follow the exact steps that they do. Certain moves really don't make sense. Now, according to the famed financial expert George Kamel, billionaires are not like the average person. And when it comes to investing, we should not invest as billionaires do because there are a couple caveats that they have. Now, the first one, billionaires invest for preservation more than growth. When we think of Warren Buffett being in Bank of America, being in Apple, being in Coca-Cola, those are more about the preservation of wealth, getting that income dollar, getting those dividends out of those companies, make a really big difference. Billionaires have unlocked the absolute highest wealth status that we know as a nation right now, and they're concerned about preserving that wealth while still growing a little bit, but not growing it like we do. When it comes to complications, when it comes to tax strategies, estate planning pools, there are a lot of reasons why they have an entire team of people to help with their wealth preservation and, of course, paying for those people. Billionaires put their money in trust to help protect the wealth for future generations so the kids are going to enjoy it as well. And, of course, utilizing those charitable donations to have some massive, heavy tax write-offs. Now, we see this with Mr. Beast. We even see it with some of the larger content creators. When you start looking at the philanthropy part of it, there is a big reason why the donations go out. When you get to that billion-dollar status or enormous amounts of wealth, giving money away not only is great, it really helps society. A lot of the donations for something that you care about or something you're close to, but it is also a massive tax write-off. Now, the second one we look at, billionaires are focused on private equity or venture capitals. This, of course, is not available to you and I. When you started thinking of like Masterworks, where now they give you access to fine art, before that was locked behind really a paywall that you didn't have the ability to. You're not in the meetings to have premium access or private deals with different companies. And it makes me think back to 2007, 2008 with the housing market crisis, where Bank of America was in need of funds. They turned to Warren Buffett. Warren Buffett gave them the money they needed. But the caveat with that, Warren Buffett said, I want a 6% return. There was nowhere in the world at that point that was getting a 6% return. He wanted a guaranteed 6% return. And through the venture capital or the private equity deals, he made that work. Now, when you start looking at private equity firms, they raise a ton of money from big investors. When you look at corporate investing, when you look at even the private investing, big companies and buying companies, we've seen this from cutting costs, improving operations, changing in leadership, even taking companies into the public realm. And of course, the biggest one that we've seen of this is Shark Tank. Shark Tank was starting with the startup companies, billionaires researching young companies that were in the startup phase and really investing in them and getting a chunk of the company up front, knowing that if they take 10, 20, 30, 50% of a company, when they start dumping money into it and when the company starts growing, they can reap those profits out of there. And for you and I, we do not have billions of dollars to invest or even millions of dollars to invest in that avenue. Now, billionaires have a much higher risk tolerance. This, of course, comes with money. When you think of the risk tolerance, most of us will take a very minimal amount of risk. I'm kind of risk averse, I guess, not looking at like doing just bonds, but looking at ETFs, having that diversification. But when you start thinking of billionaires, it really comes down to how much money do you have? Again, if I have $100,000, if I lose 10 grand, that is a really big deal. If I have $1 million and I lose 10 grand, not quite as big of a deal. If you're sitting on $1 billion and you lose $10 million, doesn't even really, not a drop in the bucket when you're sitting on $1 billion, which again is kind of crazy, but it is the scaling of the assets that makes a big difference. When you got billions, you can stomach any risk or really the high risk. When you look at hedge funds, when you look at tech startups, when you look at investing into something risky like cryptocurrency or even going into Bitcoin, losing or putting a lot of money in there could have a tremendous upside. If you're putting $100 million into Bitcoin, all of a sudden it shoots up and it's at 94K right now. Guess what? You might have made millions and multiple millions of dollars, depending when you got in, just from one single investment. Now, also when it comes to billionaires, they can absorb financial losses that would absolutely crush us. Again, when you think about billionaires, not only do they have the ability to absorb the loss because they are financially really savvy, but not only that is they have money. They can effectively lose millions of dollars, be completely fine. Regular investors like you and I, if we see the stock market go down 50%, that can be absolutely devastating to our finances, devastating to the ability to invest. And of course, we have a 9 to 5 job. When you start looking at billionaires, they can also get really big loans for a very, very cheap amount, which is kind of crazy. Now, billionaires and everyone else, they have access to loans and really an infinite amount of money if they needed it to, at a very low rate, depending where they are. You have wealth managers, you have banks that are ready to hand them cash on a regular basis, really backing whatever they want to do. For an average person, we have to use our credit score. We have to go ahead and use, spending value. There's only so much we can invest. There's only so much money that we could even borrow if we wanted to invest. We're looking at a billionaire. If you went in and said, hey, I need $50 million to invest in this startup, boom, they would go ahead and give you that $50 million. You'd be all set. If the startup does incredibly well, guess what? That is wealth in your pocket. Now, also when it comes to billionaires, and this is one of the big important parts, when it comes to investing and when it comes to the influence on the markets, when you look at really some of these giant investors, when you look at your Elon Musk, when you start looking at some of the political arena, when you start looking at Warren Buffett, one reason you can really emulate, or it seems like the markets move when billionaires invest, it is because they have the influence to do it. This is the reason why when you see Bitcoin skyrocketing, and you see it everywhere, I see it on social media, I see it, in the news, I see it online, I see it everywhere. Bitcoin is just exploding everywhere in the news. That news and that drive and that huge influence that billionaires can hold really can drive up a market. When Warren Buffett says he's selling out of a position like Apple, which he just did, the Apple stock will take a little bit of a tumble because when they declare a stock a sell, or when they go ahead and they do it as a buy, like when he bought a lot of Bank of America, or a hold like Coca-Cola, again, you can kind of influence the market and influence not only the market by what you're doing, the moves that you're making. When you start looking at a company like Berkshire Hathaway, if they're liquidating their position in a stock, there's a darn well reason that they are, and a lot of people do follow that. And the final one that we look at, billionaires have far less pressure to diversify. This, of course, when you start looking at multi-millions and really looking at the diversification, there is a little diversification, but not a ton. They really don't have to diversify. When, again, you think of a company, like Coca-Cola, where you might have $300 million parked with Berkshire Hathaway, that makes a big difference. You're raking in, and I believe they said around $19 billion a quarter in dividends that are coming out of companies. For me and you, average investors, we have to diversify. If we see a sector that takes a tumble, it can devastate our portfolio. And if you're an individual that still invests in individualized stocks, I do not recommend it all. There are a lot of investment advisors, financial advisors that are in the same spot that I am. When I start looking at ETFs, it is how I invest all of my money. I do not buy individual stocks unless I'm kind of playing around with them, maybe a very low, $500 to $1,000, really that I could stomach the loss if it went south. But overall, the majority of the portfolio, all into ETFs. It gives me the diversification. It gives me the hands-off investment approach that I'm looking for, just putting money in there on a regular basis, and it is growing exponentially. Even if you look at the S&P 500 this year, doing incredibly well. All right, guys, so that is going to do it for today's video. 7 reasons that you should not invest as a billionaire, according to George Kamel, which I absolutely love, Dave Ramsey, and I love The Ramsey Show. So guys, that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video.